Franklin Templeton Mutual Fund will be launching a Balanced Advantage Fund, its first mutual fund scheme after a gap of 2.5 years. Franklin Templeton MF went through a tough period after it shut its 6 debt schemes back in April 2020 because of lack of liquidity in debt markets. Some investors initiated legal process against the fund house. While the schemes have now largely returned the funds to the investors, legal proceedings are still on. The new fund offer or NFO will open for subscription on 16th August and close on the 30th of August. The Balanced Advantage Fund is the largest hybrid category in the entire mutual fund industry, accounting for investor assets worth 1.7 trillion rupees. To be sure, there are 25 schemes already in the category. Typically, a BAF shifts exposures between equity and debt depending upon market valuations. When equities are overvalued, the fund reduces equity exposure while at the same time increasing debt exposure. It does the opposite when equity markets are undervalued. In a recent interaction with Money Control, Franklin Templeton Mutual Fund's former president Sanjay Sapre had pointed out that Franklin Templeton India had taken a conscious decision to not launch any debt funds till its court cases are resolved. On the equity side, he added, the fund house is present in almost all the critical categories except New Age Index and ETFs. One important category that the fund house wasn't present in was the Balanced Advantage Fund, and that void will get filled up on 16th August. So how will it work? The fund will follow an investment model using price to earnings and price to book multiples to determine the expensiveness or cheapness of stock markets and accordingly increase or reduce equity exposure. Its equity exposure is likely to be in the range of 80 to 85% on the higher side and 15% on the lower side. Now, in the current market environment, the fund house's investment model suggests 53 to 54% equity exposure. If the net equity allocation falls below 65%, which is the minimum requirement for the fund to get preferential equity taxation, the difference will be met by arbitrage allocation. The exposure to large caps will range between 60 to 85% of the entire equity corpus, while the exposure to mid and small caps would be in the range of 15 to 40%. On the debt side, the fund will invest in higher rated debt securities on the credit risk curve, but within that, the fund will take interest rate reviews. Anand Radhakrishnan, who is the MD and CIO Emerging Markets Equity India at Franklin Templeton, explained to us. For example, the portfolio duration of the fixed income portfolio of their equity hybrid fund has moved from 2.5 years to 5.5-6 years, which shows that the fund manager has taken the view that the interest rates are now peaking and now may be a good time to increase the duration of the fixed income portfolio without going down the credit curve. The fund will make its debt investments in government securities and corporate bonds.